Hello, welcome to the webinar. This is Daryl Martin, and this is Module 4 that we're going to be going over. And just want to let you know up front, what we're going to be doing is I'm going to show you a bunch of tables and links and things like that, and I'm going to post them on the forum for you, like I did in the last module, on the Forex module. So that way, you'll be able to get that data. So just be aware that as I'm going through the data, I'm going to take that and I'm going to put it all in the forum, and you'll be able to see that. All right, so let's go ahead and get started. First thing here, we got the disclosures. So, of course, futures trading involves risk. You can lose money. You can lose more money than you put in, et cetera, et cetera. Make sure to read, our full disclaimer, and you can check out the disclaimer on your broker's site as well. So today's module is Module 4. It's about the futures trading strategy. So we're going to teach you basically what you need to know about futures, understanding what they are and how they work. Okay. Again, today is on strategy. So we talked about Forex strategy on Module 3. We talked about system when we talked about the one pattern for all markets, and we also talk about system in the 12 trading step video. If you haven't watched that, make sure to watch that. And as far as style, you want to make sure that you keep watching the modules, because we're going to go into style pretty soon after we get done with strategies, where we start talking about time frames, indicators, seasonals, basically how to look at the market. Okay, so the style is basically actually implementing the system, and we'll talk about more of that later. Again, if you haven't watched the 12-step trading system and the one pattern for all markets and the S3P3, make sure you watch those, okay? We're going to talk about what is a future, what are the future exchanges, what are the important dates regarding futures that you need to know, what is cash versus physical settlement, how to decipher the symbol code of futures. It can seem really complicated. I'm going to break it down, make it easy for you. The difference between volume and open interest, what is liquid and what is illiquid, and why is that important to you? What's a tick? What's a tick's value? And why is that important? We talked about pips on the last one. We're talking about ticks on futures. And we'll get into more detail about that in a second. And how they help you figure out what the actual value of the futures contract is. Okay? We're talking about what is an e-mini. If you're new to futures, and you've probably heard about e-minis, but you don't know what they are. So we're going to talk about that. What is between initial, maintenance, day trading, and spread margin? And where are some of the best margins available that you can get so you can maximize your buying power? What's a margin call? What's a loss limit level? What's a day limit level? What's a circuit breaker? We're going to go into all that. Like I said, we'll talk about the value of a futures contract. We'll go into what is an emini contract and how to use a DOM trader to see where orders are located in the market. So one of the many ways that you can do that, and we're going to talk about that specifically today. All right. So let's go ahead and get started. A very important rule. As soon as you have a futures account and you're trading with it, you need to have the phone number and the account number to your broker easily accessible. So that way, if your computer goes down, power goes out, something happens, and you're in a position, you need to be able to call somebody to close your positions. Okay? So just always know where that is. I suggest you tape it to the side of your monitor. All right. So what is the future? Well, future is a commodity, also known as a commodity, is a contract. And a commodity is really something you can drop on your foot. Okay, that's really what a commodity is. So, if you think about a gold bar, you can drop on your foot. An index really isn't a commodity. Oil, barrel of oil, you could drop that. Wheat, you could drop that. So, if it actually has something physical, then it's a commodity. If it doesn't, it's just simply a future. Okay, and it's traded on an exchange. There's something called a forward that's over the counter. It's not necessarily on an exchange. It's you and the other person, but there's no intermediate exchange necessarily. So, futures on an exchange. And we'll talk about why that's important. The agreement of the future contract is to buy or sell something at a predetermined price in the future. So, for instance, farmers need to sell crops and cereal makers need to lock in prices so they can make their cereal and, put everything together and, make contracts with distribution and all that. Oil companies need to sell oil, and jet companies need to lock in fuel costs. That's one of the reasons that, Southwest Airlines was so successful. In the early 2000s, they had, a lot of the airlines were having major issues after 9/11, but Southwest was very successful despite all the rising oil prices and the things that happened over the last decade because they used futures contracts. And then ranchers, they need to sell their cattle, and restaurants need to buy them. They like to make burgers, like McDonald's, obviously. That's a great way for them to lock in their prices. So that's sort of the basic idea of a futures contract and what it is. Now, let's go over just an example. One contract, this would be an example of a futures contract. So let's say we have a futures contract that's for widgets, okay? And it's one contract to either sell or buy, but it's for 100 barrels of widgets that's due for delivery or purchase on December 12th, 2014. Okay? So two people come together at an exchange, and they see a quote for what a contract of widgets would cost to be delivered on December 12th, 2014. And there's a quality requirement for every future. So, like how pure the gold must be, the grade of beef, all that stuff, okay? Well, the quality on this is that they have to be 50 grade A widgets in each barrel, okay? There's A, B, C, D. These need to be A. They're the best ones, okay? And the price is going to be quoted per barrel. It's not going to be quoted in, like, the full value of 100 barrels. So, it's going to be quoted in, say, $100.15, all right? And that price reflects basically the perceived value, and it's going to include the cost of storage. So basically, like if somebody has those widgets and they're storing them somewhere, that's going to be built in. So the further out a future contract goes, part of that cost built into the future contract, the value, is how long it takes to store it between now and 2012, 2013, 2014, the end of the year, whatever. And the price is going to fluctuate up and down throughout the day as, value is perceived to be different. Okay? Well, when a buyer and seller agree to the price on a futures contract, then they can literally come to that agreement, and all they have to do is hit a button. Boom, done. Okay? We've now made a contract. All right? The buyer and or seller hold the contract, and they'll be delivered to make delivery. If they're the seller, they'll be expected to take delivery if they're the buyer of the widgets. Okay? However, the buyer can sell the contract to another buyer at any time before delivery to eliminate that person's obligation. The seller can allow another seller to buy their contract from them before delivery to eliminate their obligation. So, if they do not buy or sell the contract to someone else, they have to make or take delivery. All right, and we're going to talk about that and how that works. But if they do or buy sell the contract to close it, then they have no further obligation. All right, so a futures contract, you're not going to be stuck with 1,000 cows. All right, but we'll talk about you could if you wanted to be, but that's not necessarily, the plan for most futures contracts. They're closed before delivery. Okay? And we'll talk, like I said, more about that in detail. Okay, so now that we know what a future contract is, again, it's at an exchange. So, like the Chicago Mercantile Exchange, and there's CBOT, and there's other exchanges like that. And again, that's a place where buyers and sellers come together to place orders, and market makers help facilitate that process. Exchanges, they'll take fees for providing a universal location. So basically what happens is they come together, and that's the benefit of the exchange is a whole bunch of buyers and sellers are showing up in the same place. Okay? And it may be online, but the exchange is somewhere. And the market maker is helping process the orders back and forth, the buyer and seller. Sort of like the auctioneer, if you went to a cattle auction. And the exchange itself, the company that is housing it, they make a fee. Okay? And they may also try to charge a fee for data. So that's why you may have to pay for live data. Okay? And we'll talk about later when we get into platforms and brokers and all that. We'll talk about how to get massive waivers on data fees. Okay? So here's an example of some of the exchanges. And you got CBOE futures, CBOT. There's all these exchanges are here in the U.S., Canada, Mexico. There's additional exchanges, literally all throughout Europe. Okay? And there's exchanges in Asia Pacific, and of course our pattern can be applied to literally markets all over the world, and we have students from all over the world. So whatever exchange works best for you, and there's certain rules on who can and can't trade certain exchanges. Basically, if you can't trade it, your broker's not going to let you trade it. Okay, so not to worry about that, but just if you want to trade an exchange and find out if you can, just call your broker and say, hey, do you have this, or do you know somebody who does, or how do I get access to this, or ask us. Okay. And we'll probably be able to help you out. So now let's talk about future dates. And again, I'm going to post all that so you'll be able to get access to it. And it'll be on the form in your classroom. Future dates. So there's several dates you want to know about. And a couple of them are very important. Okay, there's first trade date. That's the date that basically you can start trading the future contract. And when you go to cmegroup.com, you actually can look up all the calendar dates for any futures contract. Okay? And it'll list all this information for you. And the important one you need to know about is the last trade date. That's the date which the contract stops trading. And you don't want to get out, stop trading right before that. Okay, really you want to be out at least a week before that. And the best way to do it is to just look at the volume. I'm going to show you how to look at what's called volume and open interest. to know when the month is switched. Those are called like rollover dates. And a lot of times brokers will send out notices. Hey, you know, if you're trading an instrument, they're like, hey, you have an open contract on this. You may want to move to the next contract. But you can also just easily look on the website and it'll show you. And I'll show you an example of how you can easily tell which one is the liquid contract, which is the one you want to be trading. And it's pretty easy to tell when to move to the next month. Some platforms will even automatically update you to the next month. Okay? So, anyways, the settlement date, that's basically like after the last trade date, then they're going to define, okay, here's the price that it settled at, and everybody's going to agree to this, and so therefore, you know, you have to pay the difference if you held on to it. Okay? Or maybe you just deliver the cows. It doesn't matter. So depending on who you are and what you're doing. But if you're trading, that's where they'll come up with that final date. Like there has to be a final price at some time. And if you look on the exchange's website, they can give you all sorts of details about that. The reality is you should never be worrying about settlement date, first holding date, last holding date, unless you're actually looking at taking delivery or delivering. You know, if you have 100 ounces of pure gold and, you know, or you have a whole lot of cattle or you want to get a whole lot of cattle, that's like the only reason you should be worrying about those dates, because you should be well out before any of those dates. Okay? Again, first position date, last position date, you know, you shouldn't worry about that. First notice day is one day that you want to be aware of. Okay? You should always be out, no matter what, at least 3 days before this date. And, you know, maybe sooner, depending upon volume and open interest. But first notice date and last trade date. Okay? Those are the 2 dates that are really important to you. If you are taking or making delivery, then first delivery date is the first date it can be delivered. Last delivery date is the last date it can be delivered. So if you sold it, you got to provide it. If you bought it, then, you know, you got to take delivery. If you didn't get out and you forgot, then you're going to have to pay a fine to get out of having to make or take the delivery. Okay? They're not going to like force you to come up with 100 cows. Most brokers, or not, I'm not going to say most brokers because that's probably a negative way to say it, but a lot of brokers they'll shut you down anyway before that last trade date because they don't deal with delivery. So, just depending upon who the broker is and whether or not they deal with it. If you're in a position getting closer to that date, they'll send you a note that, hey, we're going to shut your position down by this date if you're not out, because we don't deal with delivery. So some brokers, they don't want to deal with having to make sure that takes place. Okay? All right, so cash and physical settlement. So that's the whole delivery thing we're talking about. So when things settle, it's like you got to provide 100 cows. Okay? Well, on indexes and currencies and stuff like that, you know, they don't really expect you to provide, you know, 100 all the shares of stock. And they just settle it in cash. Basically, so the settlement date, what they do is they basically just, right there, what's the profit, what's the loss, and they close your position, and you have it, and you're done, and you're out. All right? Physically settled, corn, wheat, cattle, oil, natural gas, silver, gold, things like that are physically settled. Okay? So they actually have to be delivered or taken. But like things like indexes and currencies and a lot of the financials, they just cash settle out the profit or loss in the contract, and it's done. All right? If you have more questions about that, just ask them in the forum. All right? How do you decipher a future symbol? So how do you put a future symbol together? Because, you know, you're used to, I mean, and when I say this, it sounds like so complicated, but Apple, you know, AAPL, not real hard, you know. So you just, it's the ticker, okay? But since it's a future, it's a contract for a specific date in the future, right? So there's going to be a month and there's going to be a year. And there's going to be a symbol, the ticker symbol, okay? So if you can imagine, like, let's just say Apple was a future, okay? And then it'd have like AAPL, and then it'd have the code for the month, and then it'd have the code for the year. Okay, and that would be the future symbol. All right, for delivering, say, 100 shares of Apple. Doesn't really apply in this case. There are single stock futures, but we're more, you know, focusing on the, you know, the major liquid pairs, and, you know, that's what we're going over during this class. So month symbols. I don't know why they did it this way. I honestly believe, and the guys I've talked to agree, the futures traders, they're the best traders I've ever, you know, every trader I know that's a great trader usually is a futures trader, okay? They're the smartest traders. They can look at every market in the world. I mean, think about it. You can look at currencies. You can look at stocks. You can look at forex. You can, you know, all the financials. I mean, everything. Meats, oil, metals, you know, food, ags, everything, all in one place. So they can see a lot looking at like 30 different charts. Where a stock trader looking at 30 stock charts is seeing 30 stocks. They're seeing the stock market, and that's it. So it gives you a great advantage. Well, they try to keep it a little bit complicated to keep people out, but once you figure it out, it's real easy to get in. Okay? And again, I'm going to provide this for you, and you can also Google it and find it just about anywhere. But this is the month symbol code. So, you know, if we stuck with our Apple example, okay, Then the code for Apple, if it had to be delivered in January, would be AAPL, the ticker, all right, F for January. All right, that would be it. So you basically just add that month symbol on. And it's FG, H, J, K, M. It would be a lot nicer if they could have made them, 1 through 12, or I don't know, like A, B, C, D, E, or whatever. But this is how they made it. That's what it is. You might even want to print this off and put it next to your monitor just to make it really easy. Or you could just, take it and, save it on your desktop, whatever. All right, so taking it from the forum. All right, so that's basically the future symbol, codes right there. All right, so let's put it all together. You have a gold contract whose expiration month is January and the expiration year is 2014. Well, the gold contract symbol, and I'll show you how to get those, is GC, okay? And F is the symbol for January. And fix that right there. 4 is the symbol for 2014, okay? So the symbol would be GCF4 on a chatting platform. So the symbol plus the month plus the year. Some platforms have different types of requirements on their, such as they may require a slash before the symbol, like slash GCF4. They may also require you to put the year if they have a lot of historical data. So they may have you put 14 because they actually have 2004 in the database, okay? And then, some are literally just have a totally different symbol. Nearly all platforms have a simple, easy-to-use symbol lookup feature on the platform or on their website. You can also just call the broker and ask them, okay? So there's the standard codes that you ought to be able to type in, but if they have a different, symbol for it, then you can just call them or use the platform either way to find it, okay? We go into platforms, I'll show you how to figure out what those are. That'll be on a future module, but right now we'll just focus on just going through the futures, and I'll show you how to find them on the futures website, because that's the most important one to know, because that's what most of them are going to be. So now let's talk about volume and open interest. Volume is the amount traded during a specific time. Like on a daily bar, you could have volume underneath it and show you how many contracts were traded that day. And this is a really cool thing that you can use. Last we talked about Forex. Well, in Forex, you don't have volume. Okay, there's no, if you use on true Forex, you'll never see a volume chart. Okay, or, an indicator called volume at the bottom with bars on how much volume's happened. But on futures, there are currency futures. Okay, and with that means that even if you're trading Forex spot, if you had the currency futures on a platform, you could look at the volume of the currency futures on like euro dollar. Okay, so just be aware of that for currency. That's sort of a trick. If you want to get volume, you can look at the futures. Open interest is different than volume. It's how many open contracts there are out there. Okay, meaning people that are both long and short. Not the same person, but if I'm long, if I buy and somebody else sells to me, okay, and I buy to open, he sells to open. All right, then he's short and I'm long, and that's one open contract. Okay, one open interest. It does not tell you the direction. Increased open interest doesn't tell you the market's going up or going down. Increased volume doesn't tell you the market's going up or going down. It just lets you know more and more people are putting positions on. Okay, and so if you look down here, you can really see, like we talked about, like if we're looking at the E-mini S&P 500, here's just an example of looking at, a screenshot I took a while back that shows that which contract can you tell is the most liquid contract? What's the front month that you should be trading right now if you're trading the S&P 500 futures? Should you trade December 11th contract or the March 12th, March 2012 contract? Well, looking at this, you can tell pretty quick that there's over 2 million contracts traded, just in the last day on the December 2011 contract, with only 7,000 traded on March 2012. So the more liquid contract would be the December 2011 contract, okay? And then the prior day open interest shows you that there's a lot more people holding on to positions in December 2011. There's only 21,000 total contracts being held, buyers and sellers, for March 2012. Eventually, what you'll see happen is March will become bigger than December. Okay? And this, this is an example, and of course that's going to change as time goes by. I just want to get you an easy screenshot and show you that. And, that's on the, if you just go to CME Group, and you go to indexes, and you go to futures, then you can literally just pull up the quotes and click on settlements, and you'll be able to see that right there, and you'll know instantly what is the liquid contract. That's all you have to do. Which one has the high volume and high open interest. Okay? All right, so we got that going. What is liquid versus what is illiquid? Well, liquid means there's lots of volume, fast fills, tight spreads, and the examples are the S&P 500, the Russell 2000, bonds, Eurodollar. These are all very liquid. Okay, illiquid is lower volume, so less fills, wider spreads. Coffee, cotton, cocoa, orange juice, milk. Okay, the weather, things like that. You can go to Google and then just type in traders.com and futures liquidity, and they'll actually post like their ranking for the current year or quarter of what contracts are really liquid. So one thing also I want to mention right now, there's a thing, and you can get really concerned about it or not, whatever, but it's not really the most important thing for you as long as you're trading effectively and you're not just holding positions. If you're holding positions overnight, it's more important, but if you're just trading throughout the day or during the day, it's not that important. But it's called contango, and that's basically when a contract becomes basically more actively traded in a back month and a front month. So like you got like maybe March should be the next month, but the contract of that gets more volume, and we'll go into that in the future when we're talking about seasonals. But I just want to be aware that we are going to teach you about contango. But we'll go into it during the seasonal part of diagnostic trading to explain what contango is. All right, because that just is a weird word, and it's not worth it right now to learn it. Okay, I just want you to understand futures. So the important thing is you want to trade liquid futures, so you can get in and get out. Okay, smaller spread means you pay less. Remember we talked about bid and ask spread on the last thing on the Forex module. Well, the spread is going to get wider if it's less liquid. The further out you go in time, if you try to trade a contract that's like maybe there's one contract every single month and you try to trade one 12 months out, well, that contract 12 months out is going to be less liquid, so it's going to have a wider bid-ask spread on it. Okay, you also may have a harder time getting out of something that's not as liquid. If there's only 7,000 contracts traded and maybe 8,000 people put in orders today, well, if you weren't one of the first people to put one in, then you're not the one getting in. And that brings up another good point when you're trading futures is there's a rule, it's called first in, first out, okay? Basically first in, first fill. It doesn't matter if you're trading one contract or 500 contracts. Whoever gets in line first, that's the first person to get the fill when it hits that price, okay? So it's not how big you are and what bank you are, but it is literally, it's very important that it is first. So whenever you place your order, then that's when you're going to get filled on that. So now that we understand liquid and illiquid, also understand that there'll be more liquidity during certain times of day for certain things. So like you'll see, like live cattle will be more liquid in the morning. It'll get less liquid in the afternoon. And one of the things that you can see when you hop on like CME Group is you'll be able to see like the regular hours and the pit trading hours, where they actually trade in the pit. The pit trading hours are going to be the liquid hours. Okay, those are going to usually be the ideal times to trade futures. When you're trading outside of the pit hours, they're the market maker. Okay, those floor traders are the market makers, and if you trade outside those pit hours, there's less activity, there's less orders, and remember we're trying to trade based on order flow. So you really do want to trade during like the pit hours, even though you're not trading on the pit, you're trading the exchange. It's called Globex. If you're trading CME, CME Globex exchange, and that's where you trade like the S&P 500 E-minis that we're going to talk about. But just make sure you want to trade during those hours, and I'll show you where to find those very easily. Okay. So again, if you went in and did that Google search I was talking about, then it'd show you basically here's basically liquidity, and it shows how the S&P 500, the Euro Stocks 50, the Euro Dollar, things like that, 30-day Fed funds rate, natural gas, crude oil, 10-year Treasury notes, gold, very very liquid. Okay, you go down here to things like coffee and copper. Live cattle, things like that, they're a lot less liquid. So you need to be aware of that. And just because it says they're less liquid, they're using their whole little measurement of like the last 3 years. Well, gold, obviously, if we look at this, gold is a lot higher on the list if you just look at like the last 6 months or 12 months. So, the important thing is just make sure there's volume happening there, enough that you can get in and get out without any problem. That spread should be really tight. So like on S&P 500, literally, there's one tick spread. So you get in and you get out one tick lower. And we'll talk about ticks here in just a second. So let's go ahead and go into that. A tick is the minimum move a future contract can make. So like a pip was the minimum move that a Forex pair could make. Okay, and you had to use pips because you're using different currencies and things like that. Well, with ticks, they're all different. Basically, all these contracts are different sizes because they all include different things like cows and pigs and wheat and corn and indexes and currencies and everything in between. So they call it a tick. It's just their name, tick. That's it. All right. So a point is a $1 move. All right. It could be a bigger move or whatever, and I'll show you how to find that out. But just to keep things simple. All right. So on the S&P 500, and we're going to go over this a couple of times to make sure you get it, okay? The contract ticks in quarters. So it goes from let's say a contract does tick in quarters, just any contract. So it'd go from $100.25 to $100.50. It wouldn't go from $100.25 to $100.26. It's not moving in cents. It's moving in ticks, okay? And that tick is a quarter. That's the minimum movement. So if it ticks in quarters, there's 4 quarters in a dollar, all right? Well, if each tick is worth $12.50, and there's 4 ticks in 1 point, then 1 point, or $1 move, is worth $50. So every product has different tick values, and that can be a little bit intimidating. So one, you're not going to be trading like 50 different futures contracts. I personally, when I trade, I usually focus on like the 6 contracts at a time, at most. So, but check this out. You go to cmegroup.com, you click on equity index at the top, then you choose S&P 500 futures dollar or euro. If you don't look it up, you can trade them in euros also. And then you'll notice that it says tick size outright, and it tells you tick size is 0.25. Okay, so it ticks in quarters, and the value is $12.50. So right there, that's for you. Also, you can notice right below it that it'll say basically here's the Globex hours where it trades. And it basically tells you like when you can start, when you can stop. You can start actually trading on Sunday, and it starts later. It goes later on Friday, and it puts all the rules in there. It also talks about like when it shuts down for a little bit. So between 5 p.m. and 3:15 you can place trades, and then between 3:30 and 4:30 you can place trades, and then there's maintenance between 4:30 and 5. All right, so there's like a 15-minute time, and then there's like another 30-minute time where they do maintenance that you can't place trades. So I know it's sort of weird, but just know, like, hey, I need to be out before the market closes, all right? And that's real important. We're going to talk about that in margin here in a minute, but you just need to be aware of when the market does close, so you're out before the market closes if you're day trading. Otherwise, you have to put up a lot more money, all right? So that's how you'd find that. You can find any product on there. One of your homework assignments is going to be to literally find this page and look this up. It's also going to be to find 2 other products that you want to look at, gold, oil, corn, anything like that, okay? All right, so now let's look at an example with gold. The symbol for gold is GC. You can find that on cmegroup.com under metals and then gold. And it's worth 100 ounces. One futures contract of gold is 100 ounces of gold. And it says that every tick, it ticks in 0.1 ounces. So a point is a $1 move, okay? So, and then it says every tick on CME Group, you find out every tick is worth $10. So every point is worth $100. So every time gold moves up or down, if you own a gold contract and it moves up or down literally $1, that's a $100 move. So it's definitely a lot of profit to be made on days where there's like a 20-point move in gold. Just one contract could make a couple grand. So let's say gold's at $1,400 an ounce. You just take the contract size, 100 ounces of gold, times the price, $1,400. So 100 times 1,400 equals 140 grand. That's what one contract would be worth, 140 grand. Okay? And then, if we look at something else, the E-minis. Let's talk about that for a second. E-mini is just a smaller version of the full contract. So like on the S&P 500, there's a full S&P 500. And then there's ES, which is the S&P E-mini. It's half the value of the full contract. They're not always half the value, though, because there's like a full gold contract worth 100 ounces, but there's also a mini gold contract, okay? And it's worth 33.2 ounces. So it's nearly a third of the size. And if you want to find out about the sizes and all those specs, I'm going to give you some stuff, but also you can just, again, go to the exchange's website. I'm going to give you all that information also. I'll post that on the forum for you from what we went over earlier. So the differences, this is sort of important for you to know if you're ever listening to like a live broadcast or whatever, and they're talking about the S&P. The full contracts are only traded on the floor. Okay, you can't trade them from home on your computer. All right. I guess you could call them in or whatever, but you just, you have to, basically there's a lot of rules with trading the full contracts, and you're not going to be trading them. So they tick in, 10 cents. So every tick is worth $10. Every point is worth $100. So the value for a full S&P futures contract is $100 times the price of the S&P. Okay. Well, a mini is worth half that, and it's traded electronically on CME's Globex through your broker. All right. And it ticks in quarters, 0.25. remember it's worth half the amount, right? So every ticket's worth $12.50, and that's sort of like, what do you mean half the amount? We'll keep going. So each point, each $1 move is worth $50 because there's 4 quarters and $1, right? So a 1 point move is worth $50, whereas a 1 point move in the full is worth $100. All right. So the value is $50 times the price of the S&P 500. So that's actually what the value of the total future your contract is. So you would just literally take in $12.50, point value is $50, and then you can go in and let's say the S&P was trading at $1,400, point value $50 times $1,400, and you get the value of $70,000. That's just a, an easy, simple way. All you got to do is figure out basically the contract size, which is the point value. And it's really the same formula as the other one. I put point value, but you can use contract size. And contract size is $50 times the price of the S&P. So to give you another example here, let's go into the details. You can go in and you literally, like, I'm going to put this chart up for you. And it basically, sort of a nice little cheat sheet. It shows you the different contracts that are out there, the symbols, the exchanges that they're on, and then of course I'll put the exchanges up with the link to the exchanges for you, and then the contract size, and then the month that they're traded. So there's the symbols, HMUZ type thing, or all months, like the energies are traded every single month. The minimum tick fluctuation and what it's worth, and what a 1 point move is worth. So sort of a cool little cheat sheet for you, and I will, like I said, I'll get that up for you. All right, so now let's talk about margin and the differences in margin. There's initial margin, which is the margin you need to open a trade, okay? And this is if you're not day trading, all right? But initial margin is how much you need to open a trade. And the maintenance margin, okay, is the amount you need to keep the trade open intraday. Okay, and this is not talking about day trading margins, all right? So if we just forget day trading margins for a second and think to open a trade, I have to have the minimum amount of money to get into the trade. Because remember, I'm handling a $70,000 or $100,000 contract, all right? Also, the initial margin, depending on the broker, but most of them are going to do this, after the close, you have to have the initial margin again. So if I had the initial margin to open, I can hold that position throughout the day on maintenance margin, but then at the close, I need to have the initial margin again, and when the market opens back up, they'll drop my amount back down to maintenance margin. And again, margin is the amount of money they put at hold. So maybe I'm controlling $100,000, but I may only have to put up $1,000. Okay. Now day trading margin, okay, is discounted, and some brokers offer it, some brokers don't, and some brokers offer 25%. Some people offer 10%. Okay, so let's say the margin was $5,000. One broker may literally let you have it for $12.50. Another broker may let you only have to put up $500 to trade the exact same trade. So that may be one of the factors that goes into your decision of which broker you want to use. Definitely, if you're day trading, you want one that does give you a day trading break. Some brokers will literally only give you day trading margins during the cash market hours, like 8:30 to 3 Central Time. Doesn't matter. Like if you want to open it at 7, then they're going to charge you full initial margin, but at 8:30 they'll drop it down. So you want to make sure that you choose a broker that does give you day trading margins, and at least a 25% of initial margin that they charge you. There's also spread margin, which is like intra and inter, and basically what those are is either like soybeans of say January I buy and then I sell say soybeans, let's just say December, whatever. I'm just sort of throwing some months out there right now. Or we'll say euro dollar January versus euro dollar December. Okay? So if I buy and I sell the same future, I get a reduced spread because there's less chance of it moving. If I buy one future and I sell a related future, then I can also get a discount. That gets a lot more complicated. I want to let you know what it is. And, we'll go into that maybe at a different time. Right now, the goal is just to show you margin and the differences, and so when you hear about that, you'll know about it. But they are pretty cool. They do give you a big discount, but they also don't move as much. That's why they give you the discount. So, here's just an example for you. This is showing gold, and it shows basically the initial margin is $11,000 on gold, okay? And, from when I took this screenshot, and it may be different right now. The maintenance margin is $8,500 on gold, okay? So to open the trade, you need to have $11,000. But to do the maintenance margin, you only have to have $8,500. So basically, what happens is basically $11,500 or whatever to get in, and then they won't hold all that money. They'll only hold $8,500 of it after you get in, so it won't tie up that additional money. But if you hold it past the close, they're going to go back to $11,475, and then when the market opens back up, they'll drop it over to $8,500. Okay. So that's initial and maintenance margin. And then here's an example of spread margins. And you can just literally go on any contract on cmegroup.com, click on margins, and you can pull this up. You just have to pick the exchange, the asset class. Like I chose COMEX, which is the exchange for gold on CME Group. CME Group owns CMX or COMEX. And then the asset class, which is metals, and that shows gold futures. And it shows right here that if I, buy a contract in this month and sell a contract in a different month, it gives me a reduced margin. And notice like only $100, $135 initial margin, $100 maintenance margin. Well, that's because I'm buying and selling gold. I'm just buying and selling them on 2 different delivery dates. So therefore, there's going to be a lot less movement. Now, the further out in time it is, different things could affect it. And also the bid-ask spread's wider. They're going to charge you more margin, just depending upon what it is. So just be aware that is something that's there. That's a very cool way to trade. But first you need to understand futures before you start getting into like spreads and everything else. And you have to find a broker who will do spreads and give you spread margins, because not all brokers will give you the spread margins. Some brokers will really charge you the full initial margin on both sides, even though the exchange gives them a discount. So just some things to be aware of, but those are different types of margins. But you need to know initial, maintenance, and day trading margins. Make sure you get a broker with day trading margins. All right, speaking of margins, all right, margin call. You never want this, okay? If your account falls below the margin balance, then they're going to either automatically close your trades, or they're going to call you to give you a chance to correct it, like put money in, not let you trade out of it, okay? So they're like, hey, if you can wire money over, in the next hour, then, maybe. And they may or may not do that. So to give you an example of that, if you have $1,000 in an account and you place a trade that requires, let's say, $800 in margin, wouldn't be a wise idea, but let's just say you do that. $800 is tied up in margin, okay? It's not a cost, it's just tied up. Let's say the trade that you're in loses $201. So now you're down to $7.99. That's $1 lower than $800. So they're automatically going to close your trade out instantly. Okay, and they may or may not close it out too. So you're not guaranteed of that. They make sure they take their own guarantee of that. But pretty much they're going to be closing it out as soon as they can. But they're not obligated to. You're obligated to close it. So they will close at market. So whatever price is going to happen, then it's not like you're going to get out at $7.99. Okay. They close it if the market's just falling like crazy. You may end up, maybe you lose another $50 on top of that, okay? Or maybe there's a gap, between the close and the open, or a bigger gap over the weekend, so you could lose a lot more. So just be aware that if you're doing outright futures, there's a lot more danger trading overnight and, past the closes. Now, you can get out and you can get back in, an hour later, okay, when the market opens back up. But, just be aware that, you have that gap risk and you're handling a lot of money with a little bit. So unless you have the size in the account and you know what you're doing, most futures traders are intraday traders, okay? With the exception being those who are trading spreads and things like that. Another thing is some brokers have a maximum loss amount they're going to let you lose a day. And sometimes they'll ask you what that is up front. You want to make sure you ask them if there is one. And they say, if you lose $500, we're going to liquidate all your positions that day. Maybe you have $100,000 in your account. Maybe you have $5,000 in your account. But you need to tell them what that limit is. And like I said, a good broker will ask you what that is up front if they're a futures broker, and that's what they do. And they won't allow you to open any new ones, so you can't just keep trading away unless you call them and say, hey, open it back up. Okay, some will require minimum balance to let you even open a trade. So maybe open an account, but let's say at the end of the day, you're down to $800 left in your account, and you started with $2,000. They may require a minimum balance of $1,000 to even open a trade, even if the margin's only $500. So, just be aware that those are a couple things that you need to know. Circuit breakers and limit down moves. What those are is basically they're rules that went into 1987, the big market crash. And they basically said if the market moves so much, then we're going to shut it down for a period of time. And they actually did pull them in October 1997. They actually got triggered. And they were triggered on the S&P 500 futures in October of 2008. You see a little bit of a pattern there, Octobers and crashes, every 10 years or so. But just be aware of that pattern. That's a seasonal one. But they were triggered, and but before the cash opened, and then all of a sudden they moved, and then they opened the market back up. So in the morning. So I think I want to say it was 30 minutes after the market. They opened the market back up. And what I'm going to do is I'm going to work on getting a video up. I'll probably have it up in the next day or two, maybe sooner. But that shows that it's actually the flash crash, and you can watch the flash crash through live audio cast. And you can see it happening, and it's really interesting how the CME literally moved the circuit breaker lower than normal. And the commentator's like, that didn't make sense. Why would they do that? That didn't make any sense. like a minute or two later, the market just starts crashing. You know, this is February 2010 or whatever, or no, May of 2010. Market just starts crashing and gets like right near that level, stops, and then it flies back up. They knew where the orders were going to run out. They didn't want the market to crash. So the best thing that they could do was make sure the market didn't close, because if it closed, it would be considered a true crash. And so they moved it down. That way it went down, orders ran out, it popped right back up, and they didn't have to say, hey, we closed the market down for the day. So there's a lot of things they had to clean up after that. But it's really interesting that they moved that circuit breaker literally like just in the middle of the trading day. But I'll put that video up for you. It's really cool. Okay, so let's see here. So if you ever want to find out what the limits are on the product you're trading, how far it can move, then you just hop on and log in, or go to, not log in, but go to cmegroup.com, click find the product, and there'll be daily price limits, and it tells you how much it can move. Like if the S&P 500 moves 5% up or down overnight, they will stop it from trading until the market opens, okay? If it moves down 10%, 20%, or 30%, there's different, basically, circuit breakers of how long they'll close the market. And you can go in there and go in the details, and, there's a lot more information you can find out about it. The biggest thing is just be aware of, like, that 10% number, whatever that is, because what happens is, I've seen the market a number of times, it'll get close to a certain point, and then it'll bounce back, because they know that limit. They don't want to hit a limit day. So, just be aware what those limit days are when your trading day starts. And again, it rarely happens, and be aware of it. Some things you need to be aware of. Let's say you get into something and the market literally like opens and moves that percentage. Okay, like let's say you're in corn and it gaps that 11% or whatever the limit is on that right now. So what do you do? Because 3 minutes later, after the market opened, before you can even get filled, the thing closed back down. Or maybe like 30 seconds, the market opens and it closes because it moves down that hard. You're in the contract, you're long, it's going down. Very important you know what to do. There's two options that you have. One is, if there's options on the market, a lot of times those options may still be trading, and you can go and buy puts to protect yourself, okay? Now, if it goes up, the profit you make on, the calls, on the long future will be overweighed by the puts that you bought. And I'll explain options here in one of the upcoming modules that we're going to be doing. Or you can also look at the back month, the next contract, and you could go short that contract, because a lot of times that one will not have gap moved. And that'll allow you to, it's not a perfect hedge, but it's at least a hedge to help, basically, it becomes a spread trade at that point. And that allows you just a way to hedge yourself while you're trying to get out of the position, okay? And then there'll also be a rule where they'll just turn off the price limit, and, I think it's like the first day of the month of delivery or whatever, they'll turn off the limit and just let them go. So, but they all have their own little rules. But just be aware, if something gaps and moves big like that, you need to have a plan. And one is either options, or two, the back month. And you need to get out of market if it's moving like that. Just get out of the thing, okay? So, of course, I'm not telling you what to do. I'm more educating you. You got to make your decision. But, when I'm in doubt, I want to get out. So low margins, low commissions. DeepDiscountTrading.com. And you can go on there and go trading margins, like 10% of the margin for the day. So if it's $5,000, $500. And commissions, $1 a round turn. Most brokers, $3, $4, $5, maybe $2. So literally $1 round turn. They have a very basic website. Don't let that intimidate you. They go through a major FCM, and they clear everything through them, and they're totally up and up. The thing is, they don't spend a lot of money marketing, and they don't spend a lot of money building fancy websites and all that other stuff. You call them, you can get a hold of them. Everything is there, like anybody else. $1 round turn commissions. If you want to pay more, there's a couple other companies. You can go to Apex Futures. They're like $2. They give you good margins. They also have access to Ninja Trader, like Deep Discount Trading. You can trade on Ninja Trader. And then, or TradeStation. So they have good, low round turn commissions on futures. And they give you 25% margins. So if it's $5,000, they'd make you pay $12.50 to, not pay, but put up $12.50 to do the trade. All right, so sort of last thing we're going to go over, how to use a DOM trader. DOM is depth of market. Okay, that's what it stands for. It may say market depth or depth of market, also known as level 2. You may have heard that before. Okay, and it helps you see where the orders are and how you could use that. So let's check this out. This is just a small shot I took one day because I thought it was just a great example. It was a very easy one, and these happen all the time, but this was just a really good one to use. And what I want to point out to you is, okay, this is like the high and the low for the day, so you can tell, obviously, the market hadn't been moving that much yet. So this is the low and the high for the day, and this is the volume. So the market just started going, okay? Right there. So it shows, where have this is sort of a cool. This is volume by price. On a chart, you're going to see volume by time. All right, and we'll go into this more when we go into platforms, but it's important to look at the difference between price and time, because that lets you know where orders are being filled. Okay, a lot of people are placing orders right here. Okay. Anyway, so that's a good thing to be aware of. And look over here. You got like 62 orders pending, 97, 133, 133, 167, 90, 163, 109. So nothing really significant stands out over here. Most of the levels are the same. It drops off a little bit for a tick. No big deal. Let's look at the other side. 78, 98, 111, 156. It's getting bigger and bigger. 321, and then look what happens. 56 contracts on these two prices right here, where orders are sitting right there. If I had an order to take profit at 240.25, would I maybe be better off taking my profit down here? Like maybe at 239.50 or 239.75, because it may not fill all 321 of those orders, and it may come back down. Okay? Huge lesson. Very, very important. You figure that out, that will help you so much. Now, if it does break that, it may just take off. Okay? But then again, that's why we have the trend catcher and the profit popper, right? So, it's a huge lesson. It's very, very valuable. But, so if you have profit on this side, where there's a massive, double the amount of orders that there pretty much is almost anywhere on the screen here, might want to take profit one or two ticks before that. Okay, yeah, give it $12.50 or $25 total or something. But, it's better than it hitting here, and just doing this for hours. And that does happen. All right, and that's a way to help you try to avoid that. On the flip side, let's say I am short the market, okay? And let's say my stop loss with the one pattern for all market says put your stop loss at 1239.75. All right? Well, that has a lot better chance of being hit than 1240.25, because it has to get through 400 orders almost to get there. So I may want to, this is the rare circumstance, I may want to increase my stop by a couple ticks, not because of money and fear and greed, but simply because there's a lot of orders right here. And if I'm going to get stopped out, I'd rather have to make it through those first, because it may come down here and hit those and hit those and hit those and hit those and finally go, okay, we're done, and then drop. Well, if I was right here, I was just asking for it. Well, I'm right here. Hey, if it breaks this level, hey, I need to be out. All right? So that'd be a chance where you might actually move your stop. Now, don't keep moving it. That gets very dangerous, okay? So if you see them pulling the orders and putting the orders and putting it. So if you see 300 here, and then it goes away and becomes 100, and 300 here, and it becomes 100, then somebody's jacking with the market, okay? They're trying to manipulate it. Don't pay attention to that. But if you just see it sitting there, I was sat there and I watched it. It stayed here for a while. If you see a large number really staying there, that's a good idea. You might want to have your stop loss on this side and your take profit on this side, okay? So if you have any questions about that, let me know. But that's just a huge tip. If you can get that down, you can pull up a DOM trader pretty much in almost any futures platform. NinjaTrader has one. TradeStation has this. This is actually a screenshot from TradeStation. Thinkorswim. On down the list. But this is a very cool tool. If you're going to trade futures, you have to have depth in market. Okay, and also this is how you'll actually adjust your trades as you need to. Okay, homework. Visit cmegroup.com. And then find the S&P emini, and two others of your choice. Find the tick size, the value, the trading hours, the months they're traded. Find the rollover dates and the last trade date. Know what the limits are, for the movements. And know what those price levels are at the beginning of the next trading day. Okay, just check them out and calculate that out. Find out what the initial margin and maintenance margin is. Find out what your day trading margin is at your broker if you have one. Or check them out, all three of those, at deepdiscounttrading.com. And if you have an account, compare the two. And I don't get any compensation for it or anything like that. I'm just, I like them. Go to quotes and settlement to see yesterday's open interest and volume to determine, what the liquid month is. All right. And then, of course, we'll show you in a couple weeks how to automate the pattern and do a lot of this stuff. But that's your homework. I'll post it on the forum for you. And then charting on futures. If you have a futures broker, then go ahead and do the one pattern for all markets on at least one futures contract. You could also Google free futures charts. You might be able to find something that would work for you too. They don't have to be real time, but go through and try to do the one pattern for all markets on a futures contract with the S&P 500. Now another thing that I highly suggest is download NinjaTrader, and then you can get the free end-of-day data from Kinetic untitled.com. I'll put all those links on there for you. And they have a ton of free tutorials. They'll, and we'll also provide you a ton of free tutorials on it pretty soon, and how to use that and TradeStation and MetaTrader. And notice that there's a lot of odd products when you hop on the CME's website, like weather and stuff. Just ignore those. Look at the the normal ones, like the ones that we've mentioned today. And again, I'll post all the links and the tables on the forum for you to check out. All right. Well, if you have any questions, please let me know. We went over a lot today. And, we've done, obviously, module 1, 2, 3, 4, and, we went over futures exchanges, important dates, cash physical settlement, deciphering symbol codes, the difference between volume and open interest, what's liquid versus illiquid, why it's important, what is a tick, what's its value, what's the value of a futures contract, what's an emini, what's the difference between initial, maintenance, and day trading and spread margin, and, where are some of the best margins available. What's a day limit and circuit breakers and all that stuff. And then we went into the value of a futures contract and an emini-contract, and we talk about a dawn trader and how you can use that to help you see where some of the orders are located. So that's literally what you learned today. Is a mouthful right there. In the future, we're going to cover how to apply this. We're going to get into that more when we get into the style part. You already know the system. You're learning the strategies, and then we're going to get into the style, so we can put it all together. On stocks and ETFs and forks and futures and binaries, and we'll go to options and all that. And then of course we'll go into time frames, bar sizes, risk management platforms, just everything that you can think of. All right, well, have a great day and ask questions on the forum. All right.